So, welcome back to the deep dive. I have to ask you, what if the ultimate act of financial responsibility, maxing out your 401k every single year, is actually just a mathematical trap?
A trap that basically keeps you working until your knees give out. It's a heavy thought.
Right, because, you get your first real paycheck, HR hands you a packet, and the ingrained script is just to funnel your money into a retirement account.
Yeah, you set it, you forget it, and you feel like a responsible adult.
Exactly. But today, we are taking a deep dive into a perspective that completely shatters that narrative. It's wild.
It really is. We are looking at this highly intense, incredibly viral excerpt from a show called The Wealth Blueprint.
Yeah, specifically an episode they titled The 401k Prison and the Path to Liquid Wealth.
Right, and the central argument here is, well, it's shocking to anyone raised on conventional financial advice.
Completely.
They basically claim that the traditional American retirement system is mathematically designed to benefit Wall Street, leaving the middle class trapped.
Trapped in a cycle of deferred utility and, all these hidden fees. But hey, before we jump in, we need to be incredibly clear with you, our listener.
Oh, yes, absolutely.
Neither of us is endorsing this viewpoint, and this is definitely not financial advice.
Yeah, we are certainly not telling you to log in and liquidate your retirement accounts today. Please don't do that.
Right. Our mission is just to neutrally unpack this really anti-establishment argument.
Yeah.
We want to look at the underlying mechanics of what they're saying.
Yeah, to help you understand the logic behind this highly elite contrasting perspective.
Okay, let's unpack this. The language used in this Wealth Blueprint excerpt is, it's intentionally provocative, right?
Very. The guest outright calls the 401k arguably the greatest marketing scam Wall Street ever pulled off on the American public.
Scam is a massive word to drop. Calling it a scam is a huge escalation.
It is.
So to understand how they arrive at that, we really need to look at how the source describes the day-to-day mechanics of a 401k during your prime working years.
Yeah, the foundational argument here is that you take your hardest working, most valuable dollars, right?
The money you make in your 20s and 30s.
Exactly, your 20s, 30s, and 40s. And you willingly lock them inside what they call a Wall Street vault.
A vault, wow.
Yeah, and the concept of this vault is really the linchpin of their entire thesis.
Because, the traditional mindset frames this lockup as a protective measure, right? It's against our own worst impulses.
Right, you put the money away for your future self so you don't spend it on, a sports car today.
Exactly. But the source flips that framing completely. They argue that the moment your capital enters that vault, you just surrender all functional leverage.
You do. You experience a complete loss of control over your own liquidity.
And they hammer so heavily on the penalty aspect. Say you encounter a once-in-a-lifetime business opportunity or a severe crisis.
Yeah, life happens.
Right, and you need to access your own money. The IRS just slaps you with a massive early withdrawal penalty.
On top of ordinary income taxes, too.
Yeah, it's brutal. You are essentially fenced off from the very wealth you built.
What's fascinating here is how the source contrasts your lack of access with Wall Street's total access.
Oh, this is the crazy part.
Yeah, this is where the critique moves from philosophical to, purely mathematical.
Right.
While your money is legally trapped behind those IRS penalties, Wall Street fund managers are actively deploying your captive cash.
They're using your principal to essentially gamble in the broader market.
Yes, and they generate billions of dollars in profits while doing it.
Wait, so if we are legally restricted from touching our own money and we bear all the risk of market downturns, aren't we essentially subsidizing the fund manager's guaranteed wealth today in exchange for a mere promise of wealth tomorrow?
That is exactly their point, because you have to look at the asymmetry of the fee structure.
The AUM fees, assets under management.
Right. These managers, they charge administrative and management fees every single year, regardless of the portfolio's performance.
So if the market has a banner year, they get their cut.
Yep. And if the market tanks and your balance drops by 20%, well, Wall Street still gets their cut.
It's just wild. But wait, let me push back on that for a second.
Sure.
Abandoning a 401k entirely means giving up the employer match, right? Walking away from a guaranteed 50 or 100% immediate return on your contribution seems mathematically indefensible.
It's literally free money.
Exactly. Regardless of what Wall Street is making on the back end, it's free money. How does the source justify walking away from that?
Well, that is the most common and, frankly, the most logical counterargument.
Right.
However, the Wealth Blueprint takes a really highly cynical view of the employer match.
Oh, I bet. How do they frame it?
They frame the match not as a gift, but as the cheese in the mousetrap.
The cheese in the mousetrap.
Wow.
It's a behavioral incentive designed to ensure you willingly lock up a much larger percentage of your own capital.
I see.
So the source argues that the opportunity cost of losing your liquidity for 40 years far outweighs the initial bump of an employer match. And is that because of the compounding nature of those fees?
Precisely. It's the compounding drag. I mean, a 1% or 1.5% fee sounds pretty negligible in year one, right?
Yeah, you barely notice it.
But over 30 or 40 years, the source argues that those fees act as a parasite on your compound interest.
Because the capital is essentially captive. You can't easily withdraw it.
Exactly. The fund managers have this risk-free, guaranteed pool of fee-generating assets. They are entirely insulated from liquidity risk.
While you, the worker, absorb all of the market volatility, and you can't even get to your own funds.
Right. You are asset-rich on paper, but completely illiquid in reality.
So you're basically locking your best seed corn in a silo for 40 years because you get a tax break, but letting your farm starve today.
That's a great way to put it. And that deferred promise, the hope that it all magically works out when you turn 65, that's exactly what the source attacks next.
Because the only justification for enduring this prison, as they call it, is the massive payout waiting for you at the finish line.
Right. We tolerate the lockbox because we want the pot of gold.
Yeah, we want the gold. And this is where the deep dive shifts from just the mechanics of fund management to these huge macroeconomic realities.
Because the guest introduces a concept they call the kill shot.
The kill shot, which is inflation, right?
Yes. Inflation is the silent variable that ruins almost every static financial projection.
Let's talk about the retirement projector illusion, because I know everyone listening to us right now has done this.
Oh, absolutely.
You log into your brokerage account, you find that little retirement calculator slider, and you push it out 30 or 40 years.
Yeah, and the screen lights up with an assumed 8% return.
And it says, congratulations, you'll have $2 million when you retire. It gives you a massive dopamine hit. You feel like you're winning the game.
If we connect this to the bigger picture, the source argues that this projection is actually a really dangerous illusion.
Because it exists in a vacuum.
Exactly. It assumes the purchasing power of the dollar remains relatively stable, which completely ignores the macroeconomic reality of central bank policy.
Right, they point out that central banks globally, but specifically in the US, are just continuously expanding the money supply.
Yeah, printing money. And when you inject trillions of new dollars into the system, you severely dilute the purchasing power of every existing dollar.
So the number on the screen goes up, but the actual utility of that number just plummets.
Yes.
It's like buying a VIP concert ticket today, but the concert isn't for 40 years. And because they keep printing more tickets, by the time you finally show up, your VIP pass only gets you into the overflow parking lot.
That is a perfect analogy. You still have the ticket you paid for, sure, but the value has been entirely diluted by the increased supply.
Right. And the source argues that by participating in the traditional 401k system, you are making this catastrophic trade.
You're trading strong dollars today for incredibly weak, watered-down dollars in the future.
And the reality check they offer is just stark. I mean, they say in 30 years that glorious $2 million might barely be enough to buy a standard house.
Or even basic medical care.
Yeah. And beyond the math, they add this deeply human layer to the critique, which really hit me.
The physical reality, right?
Yeah, the physical reality of waiting 4 decades to access your own wealth. They just bluntly state that even if you do get rich at 65, that's often a time when your knees hurt too much to enjoy it.
It really highlights the deeply personal cost of deferral. I mean, society has arbitrarily decided that 65 is the finish line.
Right, it's just an accepted number.
Yeah, and you're putting off your freedom, your ability to travel or start a business until a phase of life where your physical capacity is just significantly diminished.
It's a heavy realization. We're trading our best physical years to build a balance we literally can't touch.
Exactly.
So, okay, if the source views the traditional lockbox as this massive, inflation-eaten Wall Street enriching trap, they have to offer a viable alternative, right?
They do.
Because if the 401k is the prison, how does the source say the ultra-wealthy actually handle their money?
Well, the source pivots here to a concept they call the paradigm shift to liquid wealth.
Liquid wealth.
Yeah. The fundamental difference is that the wealthy do not defer their lives or their capital. They prioritize keeping their capital liquid.
They keep it accessible today. Instead of waiting 40 years, the source argues for using cash today to buy assets that generate immediate and recurring revenue.
Exactly. It's a shift from a lockbox mentality to a cash flow mentality.
And they list some specific assets, right? Like real estate, private businesses, and index funds held in standard non-retirement brokerages.
Yes, standard brokerage.
Wait, hold on, let me stop you there. A standard brokerage account offers absolutely zero tax shelter.
That's true.
I mean, every time you sell, you pay capital gains. A traditional 401k lets you invest pre-tax dollars, which lowers your immediate tax burden.
Right.
So how does the source justify voluntarily taking on massive tax drag just to keep the money liquid?
Well, the source actually tackles the tax argument head-on, particularly when they discuss real estate and business ownership.
Okay, how so?
Because while a standard brokerage lacks that immediate tax shield of a 401k, assets like real estate offer entirely different mechanisms for tax mitigation.
Oh, like depreciation.
Exactly. You can collect monthly cash flow from a rental property, but on paper, the IRS sees the asset as depreciating.
So that allows investors to offset their rental income and pay minimal taxes today, all while retaining total control of the asset.
Yeah, you get the tax benefit without the IRS lockup period.
Okay, the tax mechanics of real estate definitely make sense. But practically speaking, who in their mid-20s has the capital to just go buy a cash-flowing private business or a multifamily duplex?
Very few people.
Right. I mean, dropping $500 a month into a 401k is accessible to the middle class. Buying an apartment building is definitely not.
And that is a critical blind spot in the source's argument. It really reflects the elite nature of the wealth blueprint.
They're targeting high earners.
Yeah, highly aggressive entrepreneurs. But to be fair, the underlying principle isn't necessarily about buying an apartment building at age 25.
Right.
It's about the philosophy of control. Even if you're starting small, like building a side business or investing in a standard brokerage so you can access the funds to buy a property later.
It's about retaining autonomy over your capital rather than just locking it away by default.
Precisely. Because the ultimate goal they outline isn't just about having access to your principal. It is about building streams of income that pay out every single month, completely independent of your biological age.
Yeah, building a machine that spits out cash. In the traditional system, you just try to build a giant mountain of money and hope you don't outlive it.
Right, the accumulation and depletion model.
The 4% rule, yeah.
The source heavily critiques that. Instead of slowly draining a finite mountain of cash, the liquid wealth strategy focuses on income streams. If you own a cash-flowing asset, you don't have to sell pieces of it to survive.
And the most empowering part of this strategy, according to the guest, is that you do not have to be 65 to receive cash flow from a rental property or a business.
Exactly. So they summarize this with a real rallying cry to break the conditioning. Stop giving Wall Street your prime years, keep your capital, and retire on your own terms rather than the government's.
So what does this all mean? Like, does this mean you, the listener, should abandon the lockbox entirely tomorrow? Or is the deeper lesson here about balancing future tax advantages against the immediate power of liquid cash-flowing assets?
Well, the source advocates for a complete paradigm shift. They reframe retirement not as an age you reach, but as a financial state of monthly cash flow you can achieve at any time.
Mathematically, whenever your cash flow exceeds your expenses, you're retired.
Exactly. If you keep your capital liquid and deploy it effectively, you can retire on your own timeline, not the IRS's timeline.
Retire on your own terms rather than the government's. That's a powerful closing thought.
It really forces you to completely reorient how you look at your paycheck.
It does. It demands that you ask a very uncomfortable question. Like, who is actually benefiting the most from my current financial strategy? Am I funding my own freedom, or am I funding Wall Street's guaranteed cash flow?
It's a tough mirror to look into.
Truly. So to bring all of this together, the core takeaways from this wealth blueprint excerpts are profound. They argue that traditional 401ks basically lock up prime year capital, guarantee Wall Street profits, leave your future wealth totally vulnerable to central bank inflation, and delay financial freedom until old age.
Right. And their alternative is keeping your capital liquid, using things like real estate and businesses to create monthly cash flow today.
Yes, severing the link between financial freedom and old age.
And, whether you completely agree with this intense anti-establishment stance or you still strongly believe in the value of tax-advantaged accounts, examining these elite perspectives is just crucial.
Absolutely. It forces us to look closely at our financial blind spots. Understanding the mechanics of fees, liquidity, and inflation, it gives you the power to make conscious, deliberate choices.
Instead of just following a default script handed to you by HR.
Right. And that brings us to the end of today's deep dive. But before we go, we want to leave you with a final thought to mull over.
Yeah, apply this concept directly to your own life.
Imagine if you suddenly had access to your entire retirement balance today with 0 IRS penalties. Like you could pull every single dollar out right now penalty-free.
That would be wild.
How would your strategy for generating daily cash flow change tomorrow morning? Would you keep it in the market, locked away, or would you buy something that pays you next month?
Something to think about.
Definitely. Thank you for joining this deep dive. We respect your time, we love your curiosity, and we'll catch you on the next one.